All right. So, all right, we're welcome to the Viking Capital webinar, Crack the Code. We're going to uncover the secrets of staying one step ahead in this dynamic investment landscape. People are just entering the webinar stage here. So, Sam, thanks again for joining us. And I'll do a formal introduction in a second, but this is exciting. I know I've been wanting to talk about the economy, interest rates, inflation, the SOFR curve, and a lot of other things that are in the headlines, but really have not been demystified. And so that's sort of the goal of our discussion today. So appreciate you joining us, Sam, from Cushman Wakefield.
Happy to be here. Thanks for having me.
Yeah, absolutely. So one of the coolest things is, we at Viking Capital think it's so important to not only have, a desire and will to just buy multifamily, but desire and will to educate investors along the way so they can make intelligent, data-driven decisions as they move forward in their, investment landscape. And so that's the whole reason for some of these webinar series that we're offering you guys. And I really want to thank the people taking time out of their evening to join us tonight. And I'm going to give our backgrounds in a second, but this is an exciting time. There was questions of whether there was going to be a huge recession at this time last year. There's also questions of whether, there's going to be a soft landing, a double spike, or there's a lot of languaging was using on the different shapes of the economy. I remember last year before the pandemic really resolved. And so it's interesting to see how we've emerged. And it's also very powerful to have a person who actually studies this data on a day-to-day basis. And they have access to, I think a portfolio of over 170,000 units, in which not only do they have macroeconomic data to look at, but they look at this data within their own portfolio to really provide these very accurate insights onto what's going on with the economy. So again, we have people rolling in still. Really excited. If you guys are rolling in, go ahead and put in the chat box, maybe where part of the country you guys are coming in from. Love to see that. I'm going to go and put in here. Sam, where are you from?
I live in beautiful Austin, Texas.
Okay.
I say beautiful, but it's 105 out today, or 101, 102.
That's awesome.
It's pretty rough out there these days.
Yeah. I'm in beautiful Fairfax, Northern Virginia here. So I'm excited. We got Atlanta, we got Orlando, Vero Beach, Florida, Chicago, Bay Area, Maine, New Jersey. Awesome, guys. This is great. Michigan. So we're getting a ton of folks here from all over. Gainesville. So we really have the whole country here represented in terms of different submarkets, Sam. So it'll be very interesting as you sort of dissect and look at the data here, how there's trends depending on what regions of the country we're going to be talking about.
Absolutely. Yeah. I mean, the nice part is I get to cover the whole country, which means, all the data I look at on a regular basis is an aggregate. But the fun part about real estate is it is so dependent on the local market, local dynamics, that, when we look at construction levels at a particular market or at the country level, it means nothing if you're investing in a market that has nothing underway. Right, we were just talking about Indianapolis a little earlier, and Indianapolis, regardless of what's happening on the demand side or the job market or things like that, there's almost nothing underway in Indianapolis when you compare it to any other market, most markets around the country. And so, yes, in aggregate, it looks like a pretty good market, and then you dig into Indianapolis, and that breaks down even more, where there really isn't a whole lot of competition in individual submarkets or micro markets as well on top of that.
That's awesome. That's awesome. All right, guys, I think I'm going to get started here because we have at least a quorum here of folks who are here, and this will be recorded so you can catch the replay if you're unable to stay or experience the full webinar. And there's many people who are going to catch the replay as well. So for those of you catching the replay, hello, welcome. And let's get into it. So I have a little backstory I want to share with you guys. So I was talking to a buddy of mine, and this friend of mine, he's quite successful. He's a surgeon. was able to retire early from practice in his 40s, and he had powerful real estate holdings, and I think that allowed him to retire along with some medical inventions that he was able to patent. And so I was talking to him, hey, like, what are you doing now? And he goes, I joined this tribe, this group. I'm like, oh, cool. What is it about? And he's like, well, I can't really tell you too much about it. I'm like, what is this, like the Illuminati? And he basically suggested that he joined a group of individuals, and it's called Tiger 21. And it's essentially, you have to have a net worth of investable assets of 20 million or more to join this tribe. And there's chapters all over the country. And I was like, oh, okay. I was very curious and I was interested. So I said, can you tell me more? And we were chatting about it. And then I go, I'm curious, where do these people, where do they park their money? Where do this ultra rich or the wealthy park their money? And the answer he told me completely floored me. I was like, okay, is it bonds? Is it, is it stocks? Is it foreign investments? What, is it oil wells? Where are these people parking their money? And he goes, you'd be surprised, Vikram. He goes, 51% of their asset actually it was 55% of their asset allocation was two main asset classes. It was real estate and private equity. I was like, wow. So this is different than anything I've heard from any financial advisor, some books you read, the Wall Street Journal, things like that. So, and since he mentioned real estate, I think it's so poignant that we're going to really unpack this for you guys today. And so for those who don't know me, my name is Vikram Raya. I am CEO and co-founder of Viking Capital. We're a real estate private equity firm founded to help investors really achieve sort of financial freedom, time freedom, and a lot of the other things that they're looking for using specific passive investments. And one of the things we pride ourselves in is not only providing these powerful investment opportunities for our investors, but really educating them and giving them the tools so they can get ahead. And whether it's our investment or someone else's, they are intelligent and sophisticated as they make their decisions for their family's financial future. And joining me, I have Sam Tenenbaum. He is the head of multifamily insights with Cushman Wakefield. Cushman Wakefield, for those of you who don't know, is one of the top brokerage investment firms in the country, and they help broker majority of the multifamily deals in different submarkets. He was a former director of analytics for CoStar, and he led research on predictive analysis, risk assessment on various asset classes. He's sort of the lead multifamily economist in the country for Cushman. So I want to welcome him to the show. Thanks, Sam, for being here.
Thanks, Vic. Appreciate it.
Yeah. So with that, I'm going to share my screen and we're going to get started here. Okay. All right. So Sam, you can see my screen?
Yep.
Okay, let's rock and roll. So guys, the unofficial title for this webinar is Crack the Code, Uncover the Secrets of Staying One Step Ahead in the Dynamic Investment Landscape. And the reason why I titled it that is because, across industries, we're seeing what? Real estate markets are tough, yeah? Labor markets remain challenging, right? Federal interest rates continue to increase. Equity and debt are challenging. People are wondering, hey, is there a soft landing or is there not going to be? And the terms stagflation, deflation are being thrown out as well. And really, what is going to happen with real estate, with the economy, with the markets? And so that is exactly why we're going to go through a quick round of what I call facts and myths. This is just something fun that we put together because I know there's a lot of sensational news out there, and we want to separate what's fact from fiction. All right, you guys ready to play? So let's get into it. Debt will kill multifamily. This is in the Wall Street Journal recently. A real estate haven turns perilous with roughly $1 trillion coming due, right? So the question really is, this $1 trillion of multifamily and major operators will go out of business. Is that a myth or is that fact? So it's a myth, right? So variable debt, the kind of debt we use to buy these multifamily deals typically is agency debt, which is fixed interest rate debt. But over the last 36 months, the only way deals really penciled out was where you had to use a different kind of debt instrument, and it was a variable debt. And many, companies, in fact, probably, I would say, I don't know, Sam, what do you think? Would you say 80% of all deals in the last two to 3 years were probably done with the variable debt?
It depends what and where, but it was certainly a much higher percentage. I think it was up 10 or 15 points compared to 20 pre-pandemic levels.
So
in
yeah,
terms of
so
fixed
a
rate.
significantly higher number.
Yeah.
And this was done over the last 36 months. And so the problem is, if it was a variable debt, even though you bought a rate cap, meaning, yes, there may be movement in the rate, but I bought a ceiling or a cap on it. The people who bought these, the question is, do they have enough built-in reserves, or did the owners not implement their value-add business plan quick enough to change their income to offset the increase in debt payments? And the reality is, look, probably most firms are going to be fine. Probably, if I had to estimate, 60 to 80% we're going to be fine. But there will be opportunities there for where some firms will not be able to withstand this rate increase, and they will have to renegotiate with banks. They'll have to have a forced sale. They may have foreclosures. And in fact, this is going to be an opportunity for other sophisticated multifamilies such as us, buyers such as us. The next thing, don't invest or buy in real estate during a recession, right? You may have heard this. So the question is it true or is it false? Well, let's discuss it here, right? If you really wait until everything is, hunky-dory, the roses are smelling well and the sun's out, that's probably too late, because then everyone's already buying and you're buying at a very elevated price. So you may want to be a contrarian investor. And what I mean by that is, if the deal cash flows and despite general economic conditions, if the deal itself makes sense, you buy the deal. The next thing, stay still when interest rates are high, right? And this is also a myth, right? Throughout the webinar, we're going to show with you how higher interest rates can actually be good for multifamily and good for investors. The next talking point is, you can build wealth in any economic cycle. Is that true or is that false, right? Do you really have to only wait for a few cycles to buy, or can there be opportunities even in economic winter? And for us, I think this is true. And we're going to actually show you how we found sort of diamonds in the rough despite general economic conditions. And so let's talk about the economic climate right now. So for many people, they believe that the current economic climate may seem bleak in the news, but what they're seeing that, the federal rate increasing, unemployment is decreasing, inflation is slowing. So those are actually indicators that we're actually coming out of our economic slowdown, and people are continuing to spend money. And so we're going to show you how this increased unemployment has supported headroom on rent growth. We're actually still seeing rent growth in different markets, and especially across our portfolio. And this is not to say that there's no recession or there's no, flatlining of the economy for a while. All it means is saying there's opportunities in specific markets if you're careful and if you're looking at economic data to make data-driven decisions to go ahead and get into deals that make sense. And you're never going to know when the trough is. So the key is really to be aware, like when you're as close to the bottom as you think you are, that's what we call buyer's market phase one. And that's when you want to start getting in. And some of the early movers, the more sophisticated movers in multifamily are starting to get into markets. I've seen large private equity groups, hedge funds, sovereign wealth funds, and institutional multifamily selectively start getting into the purchasing side of multifamily. And in terms of embracing opportunity, by understanding key market statistics and insights such as the SOFR curve, understanding really, what the experts are saying, and looking at market projections and looking at risk reward dynamic for your investments, looking at the power of getting good fixed debt. And the way to do that right now in these markets is assuming that debt, and then unlocking growth for your financial portfolio and doing strategic value adds and looking at in markets that are overlooked, what we call the blue ocean strategy. You can really embrace opportunity. And so let's talk about interest rates here. Rate hikes typically decrease inflation, and then as the rate decreases, this can sometimes increase inflation. And so this is a tool that the federal government uses to stabilize the economy. This is what the Fed uses. And so the trick is to know, during these different economic cycles, what is the investment strategy? Is it a buy strategy? Is it a sell strategy? Is it an optimization strategy? And so by really learning economic cycles and market cycles, we can tailor our investment strategy for our company and for our investors. And with that, I'm going to let Sam really break down interest rates and all the other things that we're seeing, the trends, so we can have a deep understanding and make those powerful decisions. So Sam, take it away.
Yeah, thanks, Dick. There's a lot of content here, and this could be its own separate webinar, like just these handful of charts alone. But I'm going to try and get through them in a way that makes sense to people. What we've seen over the last 18 months or so has been one of the fastest rate hike cycles in modern history. The only other time we've seen a more aggressive rate hike cycle, it's not on this chart, but was the early 80s, the late 70s, early 80s. I remember my first boss, coming into the office one day, and I was complaining about how, oh, I can't afford to buy a house. It's so expensive. He's like, Sam, let me tell you, when I bought a house, my first house, this was in 1970 something. I don't remember exactly when. He said, my interest rate was 11%. And I was like, that's great. I was, 23, 22 at the time. So it didn't really occur to me then, but that's sort of, that was the most extreme rate hike cycle. And Vic, you sort of alluded to this earlier, that this is what the Fed uses to try and pull back inflation. They try and make ultimately the cost of borrowing more expensive to people, which then leads to people spending less money on goods or contraction in economic growth because it's expensive. And these companies, whether it's corporate debt, whether it's real estate debt, it's more expensive to service that debt. And that increased debt service ultimately then gets passed through, so on and so on and so on. But the whole reason we're seeing this, Vic, if you flip to the next chart here, the whole reason we're going through this is because we've been on this really rocky road with inflation. You look at the peak year-over-year inflation scenario back in June of last year, peaked at about 9%. That is extreme. The Fed's target is about 2 to 2.5%. So we're talking almost 5 times what their target rate is, right? An extreme level. Obviously, I don't need to tell everybody on this call, we had a pandemic. It created all sorts of issues. It made the economy really lumpy. The easiest way to explain this is we all remember what happened with used car prices and the lack of semiconductors and all this stuff. The pandemic did some weird stuff to business cycles, and that ultimately led to some of the most inflation we've seen probably in my lifetime. And that is really tough. But as we look forward here, this is where the market has gotten really optimistic. Vic mentioned the soft landing. We've brought that headline inflation from 9% down to 3 and change percent. So we're within spitting distance of the Fed. But a lot of that was pretty easy to do. You look at some of those. The way to think about this is the year-over-year calculation is the sum of month-over-month calculations. Not quite perfectly mathematically, but conceptually, that's what we're going for here. And so you look at the path to 2 to 2.5% is going to be a little bit tougher to do, which means the Fed is not necessarily incentivized to cut rates immediately. Will they cut rates? Yes. Rates are not going to stay where they are today forever. But the Fed has 2 mandates: price stability, which is basically inflation, preventing inflation, and full and maximum employment, or full employment. So right now, the unemployment rate is hovered around 3.5%. That's a 50-ish year low. That is full employment. We've achieved mandate 2. We're done there, right? We've done the full employment thing. Price stability, not quite all the way there. And so our projection is that we are likely to see rates hold until kind of the early to middle-ish of next year, when we start to see rate cuts, because either one of 2 things will happen. We'll start to see the unemployment rate tick up a little bit, or we'll start to see inflation get back closer to the level that they want to see, and they'll feel a little bit more comfortable letting up off of the gas in terms of interest rates. And so
Sam,
that's
I'm starting to see some questions among different parties throughout the country that are saying, is the 2%, is that realistic? Is 5% the new 2%? Can you sort of speak to that? And do you think the Fed is really going to take it to the 2?
I think there's a lot of reasons to think getting to 2% is going to be very difficult. We just had a decade plus where inflation couldn't get to 2%. We tried as hard as we could to get to 2% inflation, and we really couldn't. This isn't a longer term series, but if you looked at year over year inflation figures, we're talking like 1.5. That was sort of like where we peaked out. And so we spent a very long time below that threshold. So, if you look at a longer term series, we average out to 2% over a long term time frame, and that's kind of where we want to be. The Fed is going to be really wary of backing off that 2% target because they've put it out there that that's their target. And so I think, reading the tea leaves, it's too early to say we're giving up on 2%, we're happy with 3. But I think when you look at the decoupling with China, which has been a really large inflation sink for the world, between the US, the decoupling between the US and China, I think there's reason to believe that inflation might have a hard time getting back to 2% flat. It's possible, but if we're at 2.25, does the Fed feel a little bit okay with that kind of running free? I think probably. I don't think 3. I think 3 is a little far off from that level because we're at 3 now ultimately.
Got it.
The reason that interest rates are so important, and the reason we track this is, we were looking right before this at the Fed funds rate. We were looking at inflation. Ultimately, that flows through to debt costs. And the way that I look at real estate and the way that I think about real estate is it's priced very similarly to this triple B yield. You can see in that dark blue line there, that triple B yield is on corporate debt levels. And that pricing, you can see, dovetails very nicely, if you go back one chart, dovetails very nicely with debt costs. The ACLI data here, that is life insurance lending costs. And you can see it's pretty much right on top of that triple B for most of the time frame. And so the reason this is obviously important is when you start to look at and evaluate real estate, what ultimately drives the decision making, and Vic will back this up, is what is your debt cost today? And those debt costs, you can see, have gone up fairly dramatically in recent. Doesn't mean that you can't make money. That doesn't mean that there aren't good deals to be had. It just means that debt's more expensive. When we think about where inflation is going, one of the things that I look at too is this concept of inflation minus shelter, X shelter. The reason for that is the way the Bureau of Labor Statistics is a really esoteric thing. I won't go into it in detail, but the way they calculate rent is lagged between 9 and 12 months. And so right now we're seeing that CPI shelter inflation peak out. Whereas the reality is rent growth has slowed from the 2021 peaks. It's not to say that it's we're not seeing any rent growth. We're still seeing pretty good rent growth. We'll talk about that in a little bit. But when you consider the fact that that's lagging, it means that there's justification for removing shelter from the overall inflation number. And if we do that, overall inflation is not 3 and change, it's 1%. Last month, it was 0.7%. So when it comes to the inflation thing, we're pretty close to having it mostly behind us. We're going to start to see over time, over these next 6 to 12 months here, some pretty good inflation prints, which I think is more justification for the Fed to start pulling in overall interest rates and providing opportunity to the market.
So guys, one of the biggest shifts over the last couple of years has been this LIBOR to SOFR sort of curve shift. The LIBOR, which stands for the London Interbanking Offered Rate, was used for banking as a benchmark in interest rates for short-term interest rates. And in 2021, the financial agencies all over the world have decided to move to SOFR. And the reason why this is important is it is more accurate and it's more powerful instrument. And so SOFR stands for a secured offering finance rate. And really, LIBOR, what we found was it was not as reliable, and it was being able to be manipulated based on transactional data. And so now with SOFR, we find it to be actually much more tangible data and accurate, and it helps us in our financial modeling. And so I'm going to let Sam now talk more about how this is important in real estate and multifamily.
Yeah, I mean, ultimately, this is the benchmark rate that debt costs are off of. When I think about the SOFR curve, and the forward curve is really what we're talking about here. And the reason that it's important is the shape of this curve determines debt costs. Ultimately, if you're using variable rate debt or floating rate debt, you're maybe at SOFR plus some spread on top of SOFR, right? And so if SOFR is planning to come down, or we're expecting SOFR to come down, that is where the market is. You may get better pricing, you may get better pricing on your interest rate cap, you may get better just general floating rate debt costs over time, but it's a bet you're making, right? You're betting essentially that the SOFR curve will follow this curve. But by and large, the way that I think about this is really, where does the market think interest rates are going? And you can see clearly that the market believes that over the next 6 months to 12 months and then beyond, that interest rates are dropping pretty considerably from where they are today back to closer to 3.25 or so, I think is where it gets down to based on that chart there. When we look at where interest rates are going for the rest of this year, that's where this right chart comes in. This is where we figure out what the market is telling us, where they think interest rates are going over the next 6 months or so. And you can see the market is pricing in a very low likelihood of one more Fed rate increase, and then a bunch of rate cuts starting in early 2022. So this is roughly what they're pricing in. Obviously, the Fed doesn't move in 5 basis point increments. They move in 25 basis point increments. But you can see cumulatively by March of next year, the market expects at least one rate cut between now and March of next year. I personally think that's a little aggressive, but it is certainly within the realm of reason here that the shape of the curve here is very correct. It just might be moved forward or pulled closer to the current time than it may end up turning out.
And how we as operators and sponsors and as real estate investors, we use data to make our decisions. We have a storehouse of data. We have market experts across the country. We have property management companies that we're able to pull their full portfolio and distill down information and key metrics that help us make decisions. And so typically we want to buy deals where the cap rate is already expanded. It's higher cap rate, for example. And by us doing the value adds, by doing all these things, and by timing the market cycle, we end up selling when there's more of a compressed cap rate. And that sort of puts, it's putting fuel to the fire for our profitability. So we have an immense amount of profitability because of that. The number two thing is utilizing low fixed rate loans. And so either we assume a low fixed interest rate, right? Or we can wait for market timing where the interest rates do drop. So those are the two ways to get that low fixed interest rate loans. And then finally, really doing strategic things to the asset to optimize the value of the asset. Remember, there's forced appreciation and there's organic appreciation. Forced appreciation is us doing a value add approach, whether that's operational value add, it's a physical value add, renovations, adding a pickleball court, you name it, we can do it to the property and rebadge it, rebrand it, and raise the income of the property. And then the other thing is if we buy in emerging markets, these are key markets all across the country due to pandemic shifts, due to demographic shifts, due to new household formations, we're seeing migration and there's supply and demand mismatch. And so if we buy in a place where there's limited supply, high demand, that organic growth can also balloon up the value of the asset. So with that, we're going to talk more about recession-proof investments, and we're going to have data to sort of back that up with Sam.
Yeah, I think this chart is a good way of contextualizing what happened during the financial crisis. So this is back in 2008. The relative performance of multifamily doesn't necessarily mean that the property type is completely immune from rent losses or vacancy increases or performance issues. And obviously, this is all in aggregate across the country. Some markets, some properties did better than this, some properties did worse. But relative to commercial real estate as the asset class, multifamily is the only needs-based asset class out there, right? People need to live somewhere. People don't necessarily need to have office space, certainly in this environment right now. People buy less during recessions. People ship fewer goods during recessions, but people still ultimately need to live somewhere. And as a result, during the financial crisis, multifamily saw the smallest vacancy increase and the least rent losses of any other commercial real estate asset class out there. So far this year, there have been a lot of stories, whether it's in the Wall Street Journal, the New York Times, all of the apartment data news sources out there. A lot of them talk about the huge slowdown in rent growth. We're seeing really rents pull back a lot. We're seeing, a huge competition for tenants. And it's not to say that it isn't true, but a lot of it is based off of sort of a surface level understanding of what's happening in the marketplace today. You look at that left chart, that's year-over-year rent growth. You can see we were pushing 14% rent growth nationally in 2021 and early 2022, and that's backed off. Right now, we're at about 2%, give or take. It's like 1.8 or so year over year. That's a pretty poor number when you consider that inflation's still in the 3% range. But the reality is, we're coming off of a really extreme growth trajectory, and so the base effects, like we talked about with that inflation chart earlier, are really kicking in when it comes to rent growth as well. We saw huge seasonality, in particular in the third and fourth quarter last year. So while the year-over-year figures have pulled back, they're actually slightly likely going to accelerate in the second half of this year as those base effects start to work for the year-over-year calculation as opposed to against the year-over-year calculation. I think in this volatile environment, one quick thing too, that right-hand chart, that year-to-date rent growth is a much better way to look at rent growth so far. And what we're seeing is rent growth this year has been pretty much normal. You look at that bar in 2023, it's basically the same size bar as 16 through 19. It'll be a little bit lower than 19, a little bit higher than 16, but right in that range of quote unquote normal rent growth, which to me just says we're about to go back to normal after, as you see there, 2021 and 2022, two of the most extreme years for rent growth we've ever seen nationally. One of the other key things that I watch is, are renters able to afford apartments today? We've all seen how expensive it's gotten to live in this country, how expensive rent has gotten across the country. I live in Austin, Texas, where rents have gone up, depending on the data source you look at, but somewhere between 10 and 30% since the, or sorry, not 10%, somewhere between 20 and 30% since the start of the pandemic. That's an extreme level of growth. Can people still afford it? Well, one of the third-party companies we work with is a company called RealPage, and they track incomes for when people apply to apartments. And you can see on that left-hand chart, they continue to rise. And if you plot that with rent growth on that right-hand chart there, you see that income growth led rent growth caught up and maybe slightly overtook it in the second half of last year. But you can see income growth is back to outperforming rent growth, which to me just shows that renters are still able to afford apartments, which is just further bolstered by the fact that the second quarter demand number we saw nationally was the third best demand for multifamily housing of any quarter since 2000 outside of the pandemic. Right in line with 2018, 2019 levels of demand in 2023. So that front door demand is really there. People want to live in apartments. People are moving. People are creating households. It may not lead to the extreme levels of rent growth we've seen over the last 2 years, but that doesn't mean the market's falling apart. The other thing too that we see here is NOI growth for commercial real estate tends to follow inflation pretty well. It's not always one-to-one. Sometimes it outpaces. Multifamily is actually closer to the broader CPI number. This is all 4 property types that we're looking at here. But the reality is it tracks it pretty well. And especially in the multifamily space, where the leases are typically 1 year long, it allows the landlords to reset their rents to inflation pretty regularly, or at least keep up with inflation pretty regularly, sometimes outperforming it, sometimes underperforming it, but typically it's not underperforming by a wide margin, just given the expenses that go into multifamily that are often passed along to tenants as well.
And I think this is powerful, Sam, because as rent growth increase, that drives NOI, and NOI is a driver of the value of the properties.
Right.
So in some asset classes, inflation wipes out the value of the asset. In real estate, or specifically multifamily, it actually bolsters the value of the asset.
Yeah. Yeah. And you have to think about this chart too, as it attaches to all commercial real estate. You've got hotels as a great example of this, right? During the pandemic, hotel income growth went to zero. People weren't traveling, people weren't going anywhere, they were staying in their homes. And so what did that mean? They were taking bigger homes, they were renting bigger apartments, they were buying bigger homes. We all remember the frenzy of the single family market during the peak of the pandemic as well. So while this is for all asset classes, I recognize that loss there in 2020, that NOI loss there really didn't materialize in the multifamily space. Which brings us to this great, it's almost like I do this for a living, which brings us to this great transition where we talk about how broken the single family market is today. You look at that left-hand chart there, and that's rents relative to the median mortgage payment when you make some really generous assumptions and don't include things like taxes, insurance, upkeep, any of the things that you have to do when you own your own home. Right now, the difference between the current mortgage payment and the quote unquote normal relative mortgage payment compared to rents is about $400 a month different. Now, again, that doesn't include taxes, insurance, upkeep, all things that get factored into that multifamily rent. So this isn't quite apples to apples. And I'm doing a very generous assumption here because most people don't put down 20%. They put down 7%, I believe, is the average down payment for homes, which would include PMI. Then you have to calculate PMI. But the reality is we've never seen the single family market this dislocated from the rental market in modern history, going back to 2000. It's never been this broken, even during the financial crisis and all that. If we go back to that chart quickly there, just one more thing to mention too. That right-hand chart, that's data that comes from our own portfolio of properties we manage. Vic mentioned, the 170,000 plus units that we manage across the country. We track why people are moving out. The share of people moving out to go buy a home hit a low at the end of last year. It's dipped down again as interest rates have ticked up in the last couple of months. It's really well correlated with this. We're seeing fewer and fewer people of our residents at least leaving to go buy a home, which just means that they're going to be renting for longer ultimately, and is a further boon to the multifamily market. As we think about where cap rates are ultimately, because that's ultimately how we're valuing these investments, we've seen cap rates move up pretty dramatically. They're back to basically where they were before the pandemic, at least using this methodology. They're up a little bit more in certain markets and others. But the way to think about this is a really great buying opportunity. It's not to say the cap rates are going to go back to where they were. It's not to say that where everything was perfectly priced. But if you look at the SOFR curve, which is that chart we were looking at earlier here on the right-hand side here, if you expect interest rates to fall, you would then expect cap rates to fall along with it. And so right now is the time, because we've seen that pricing dislocation come in. We've seen some of those stressed buyers. It's not to say that every buy is going to be the best buy you've ever bought, but typically speaking, the rule of thumb is buy multifamily when the market is dislocated, when you can take advantage of some stress situations, because you're buying at deals and at a low enough basis where it makes a lot of sense, because ultimately it's going to, the pricing of the assets are going to increase, especially given that the replacement cost, the cost to rebuild that apartment building is going up in a way that is hard to replace the existing asset for the price that you're buying said asset at.
So guys, as we share with you all this data, we want to share you a couple of case studies of how we're actually using this data, this methodology, and showing you real life scenarios. And so, with the interest rates being high, with sort of instability in the markets, we found a deal in Atlanta called Elevated Green, and it was a 2005 vintage, nicer property from a institutional owner, and we were able to secure it for a 3.6% interest rate. It had 94% occupancy, and it's already on track for a 15% return, average annual return, and we're doing a value add plan on this, and there is plenty of headroom. I mean, when we're cycling out the rent roll, we're getting these large rent bumps, and it's in a location where there's a ton of employment in southern part of Atlanta, where there's logistics headquarters. So there's a lot of different employers. There's these like artificial intelligence based warehouses that are really high tech, and all of that is leading to high occupancy, high rent growth, low supply. And again, we're protected from the volatility of the debt markets because of the fixed interest rate. And we did the same thing again in Indiana, near South Bend. We have this deal called Park 33. It's a 2018 core plus asset. And the interest rate here is even better, 3.08% we got, 98% occupancy, and we're targeting at least a 14% IRR on this deal. And the income, as Sam had mentioned, on some of these properties is quite high. So this is like, I think $85,000. So they can definitely afford the rent. This is what we call renters by choice. And so these are sort of diamonds in the rough we're finding after looking over 1,500 to 2,000 deals. We sort of cycle through and we distill it down to these kind of deals where it still makes sense. We're buying at a discount, expanded cap rates in good markets, with a strong value add, operational value add, as well as a physical value add. And the ownership has maintained it. So we're not putting a lot of money into deferred maintenance, which does not necessarily translate into the increase of the property of value, but we're actually putting into rent generating value add improvements. And the profile we like to look at, there's 4 different types of investment classes. There's opportunistic, which is sort of like war zone, Section 8, a lot of rent growth potential, but a lot of maintenance problems and a lot of management issues. And then there's core, which is A class, triple A kind of properties that are like in downtown, super luxury, and that they may be actually not the right play in this type of market cycle when there's a little bit of instability in the economy. So we choose this value add core plus. These are safe, stable properties, B plus, A minus kind of deals that are ripe for us to do our typical Viking style value adds, and Elevated Green and Park 33 sort of fit there. They get the most amount of, we get a good leverage, and they get the strong returns with limited risk. And that's how we optimize the risk reward ratio there. And so guys, we've presented a ton of data, a ton of information, and I've presented these last 2 deals, Elevated Green and Park 33, which are opportunities still available for investors, but they are closing up soon. So as we go through here, do you really want to buy when everyone's happy, euphoric, right? Complacent? That's actually the point of maximal financial risk, right? So we don't know where we are in this trough exactly, but we're probably closer to the bottom than the top. And so this is what Warren Buffett says, buy when other people are fearful, that's the opportunity for you. So the point of maximal financial opportunities right here. I don't know if we're anger, depression, hope, but this is where we see opportunity. And over the next 6, 8, 12, 14 months, we're going to start seeing more and more deals come on the market. We're going to see pricing starting to go up. And it's great that we're getting these deals at sort of at a discount, if you will, and an expanded cap rate. And so, with Viking and in general with multifamily, the goal is, tax advantages, to hedge against inflation, to buy deals that appreciate and or increase over time, to have long-term cash flow. And obviously when we sell, to have a large profit center as well. And so if this was interesting to you, and if you found value out of this, and if you're interested in finding out more, why don't you book a lifestyle wealth strategy call with our team today? We're available, 24/7. So just click on this link. You'll be in the chat as well. VikingCapitalInvestments.com. You can just book a quick session with us. We can just figure out what your wealth strategy is, what you're trying to do. Are you trying more cash flow? Are you looking for more appreciation, looking for tax advantages? And we can help architect a plan for you. And I'll stop sharing my screen now. And Sam, I want to thank you so much for your information and the knowledge you were able to share with our investors. Sorry, you're on mute there.
Of course, it wouldn't be a webinar if that didn't happen. Thanks for the invitation. I've enjoyed sharing this.
Okay.
And appreciate the opportunity.
Awesome. So I think I know there may be some questions here, but just due to the limited time, we're going to get some of these questions answered by our team. But I wanted to thank everyone for joining. There will be a replay on this. And then, guys, we're available and open. Just click on the link below, the vikingcapitalinvestments.com. It's in the chat box for you guys, and book a call. And we'd love to share any questions, share about our portfolio, share about our strategies, share about what we're thinking about in terms of different market centers around the country. And then again, if you want a copy of this presentation, we'll have it available for you as well. So Sam, thank you again. Have fun in Austin. And next time I come out there, we'll have to hang out.
Sounds great. Looking
All right.
forward to it.
See you
Take care.
guys. Thank you, everybody.